Okay, have your pen, have your paper by your side. Let's get in. If you are excited to be on this call and you're excited to learn what we are going to be talking about today, I want you all to go on the comment section and type excited. Type excited. Get to the comment section and type excited. Get to the comment section and type excited. 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 If you're excited to learn how to stop blowing your accounts, how to stack the odds in your favor, how to make sure that from day onwards, whether this is your first time trading in the forex market or this is your, you've been trading the market and you've been blowing your account, today you are going to learn how not to blow your account. You're going to learn how to maintain a profitable curve in the forex market and consistently make consistent money. Because this is one thing I believe. The reason why a lot of people call forex gambling is because of the attitude that most of us that come into the forex market, the attitude that we adopt, the way we trade, the things we do. That's why it's easy for somebody to come out and tell you there is nothing different from what you are doing and what somebody who is betting in, a bet Niger person is doing. But there are people that are consistently profitable in the forex market. According to results, 95% or 95% of people who trade the forex market lose money. But there is 5%, and these are people. They are not robots. So today you are going to learn how the 5% are consistently profitable and are making money from the market and are using this to build a business for themselves. Because if you don't know it today. The bank where you keep your money, use your money to trade the forex market. But you've never heard that the bank blew or the bank did what? Lost your money. So today you are going to learn what the 1% know about maintaining consistency in trading the forex market. So we are going to get started. I appreciate every single one of you that are not excited. We are just going to get started right now. So officially, we are starting, all right? So today we'll be talking about a particular topic that I hold dear to my heart. This topic was what changed my trading game. I've been in the industry my first 3 years. I thought that becoming successful in the forex market was all about learning one strategy or the other. And so many of you can relate with me. When you meet 100 traders or you meet 10 traders, eight out of them, the only conversation you can hear in that environment is, what is your strategy? What are you teaching? What are you trading? What is your strategy? You trade SMC? Do you trade ICT? They are all talking about strategy. So I want you to begin to ask yourself, if everybody is talking about strategy, but everybody is blowing accounts, then is strategy really the only thing that you need to become successful? So today we are going to dive into it with a topic I call risk to reward ratio. And this risk to reward ratio topic is poised at helping you understand and learn how to stack the odds in your favor for consistent profitability. The only reason why I'm here, the only reason why this training is ongoing is because we need you to learn how to stack the odds in your favor. How to stack the odds in your favor. Because if you have these odds in your favor, that means you have an advantage. And with that advantage, it will put you in a position of consistently becoming profitable in the forex market. So let's dive in. So now, the objective of this class, my goal is that by the end of this lesson, you should be able to define risk to reward ratio. A lot of us that are trading the forex market, have been trading for 3 years, does not even know what a risk to reward ratio is. Majority of us that trade this market don't even know what it is. Then apart from that, you're also going to be learning how to apply risk to reward ratio as an effective risk management strategy. In addition to that, you're going to be also learning how to understand and calculate part of the risk management strategies called trade expectancy. And most importantly, you're going to use all of this to build a trading strategy with a positive expectancy for consistent profitability. Every single one of us that is here to learn how to be profitable. No matter the strategy you're coming to learn, no matter what brought you here, you are here to learn that strategy that will make you consistently profitable. But today I'm telling you, and we are going to learn about that strategy is not enough, and we are going to go into it. Now, how many of you have seen or heard about the 90-90-90 rule? How many of us have heard about the 90-90 rule? What the 90-90 rule says is what? That 90% of traders lose 90% of their capital within their first 90 days of account opening. 90% of retail traders lose 90% of their capital within their first 90 days of account opening. Now, I want us to come to the comment section. Do you agree with this? If you agree, I want you to type 1 on the chat box. How many of us have been victim to this? How many of us agree with this? I want you to type a 1 on the chat box. A 1 on the chat box. Every day I hear these stories about, I don't know what is happening to my account. I see that I keep losing money. I don't know what to do. I don't know how to manage. I don't know what to do again. So many of us are stuck in this thing. 90% of retail traders lose 90% of their money within their first 90 days. And we are going to explore why and find a solution to this today. Okay? So now why? For us to even understand why, because that means that before you even go into trading, the odds are already stacked against you. And why is the odds stacked against you? Listen, today's class is a reality check. I'm not here to sing music to your ear. I'm here to tell you the reality. If you are new and you want to get into forex, you will learn the reality and you will learn how to navigate the reality. If really profitability is what you are after, if profitability is what you are after, then today you are going to learn how to become profitable. But for you to become profitable, you need to know the truth and you need to accept that truth. Okay? So why is this rule happening? So it begins with what we have all learned. And most of us would always ignore, or most of us think, okay, yeah, because it's the basic. First of all, it begins with what exactly is forex? Forex is what? A business where you come in and you do exchange of what? Currencies, right? Now we know that the forex market is the largest financial market, the very largest financial market. Now, why is the forex market the largest financial market? It's very simple. Reason because it is the only market that does what? It is the only market that has nothing less than $7.5 trillion passing through it every single day. What that means is that what? About $7.5 trillion worth of transaction happens in the forex market every day. Now, no matter, in as much as this sounds like a cliche, it's lovely, it's good to hear and to know that you're doing a business in the industry that is the largest industry. This comes as a very big disservice to most of us. And I'm going to tell you why. Now, it is the largest financial market basically because of the caliber of people that do business in the forex market. I want you to pay attention. Now, who are these people that do business in the forex market? We are talking about the government institutions. We are talking about the commercial banks, the central banks, the corporations, the investment funds, and then we, the retail traders, right? Good. And according to the BIS, which is the Bank of International Settlements, according to them, 95% of this 7.5 trillion comes from a particular caliber of people that are considered the institutional traders. Now, who are these institutional traders? I'm going to show you in a jiffy. We are talking about the government. We are talking about the banks. We are talking about the central banks. We are talking about corporations like hedge funds. We are talking about investment funds. Now, why are they considered institutions? Because they are trading the market with billions and trillions of dollars. That is why they are considered institutions. And according to the Bank of International Settlements, according to their statistics, about 95% of this money that is traded, that comes into the market, comes from the institutions. Only 5% of the trading volume come from the retail traders. And who are the retail traders? You and I. You and I. We are retail because what? We are trading with a smaller amount of money. Now, this is where I want us to start thinking. Now, if someone has 90% chances, that means that institutions, if they have 95%, they are the ones bringing 95% of the money in the market. And we, the retail traders, are the ones bringing 5% into the market, right? If you're a retail trader, you trade as an individual. That is what makes you retail. You trade on your own. Collectively, our money makes up 5% of what comes into the forex market. What that means is that what? The 95% has control. The one who has more money controls price. Let me say it again. 95% of the $7.5 trillion that comes into the market comes from the institutional traders. Now, if that percentage comes from the institutional traders and our own is 5%, what that means is that we, the retail traders that are bringing 5% of this 7.5 trillion, we are not in control. We don't even have any control to move price. Because if price respects the forces of supply and demand, that only means that what? Whoever has more money can control the demand and supply. That means the person that has more money controls the price movement in the market. When they buy, the market will buy because they have the more money to pull that weight. When they sell, the market will sell. So at that point, I want to ask a question now. At that point, when we know that 95% of the money that comes to the market comes from them, and they are the ones controlling the market because of the size of the transaction happening from their own end, do we still think that we have control over what happens in this market? Yes or no? I want to see answers on the chat box. If they are the ones that have control over the market, do we still think that we have any form of control in the forex markets? Do we still think that we have any form of control in this market? If they are the ones, their money is the one controlling price, deciding if price is going to buy. Because when we learn strategies, around every strategy that we learn a strategy that tells us where to buy and where to sell. That means you're actually learning a strategy that is putting you or maybe deceiving you into believing that you have control. Because for you to go and buy a particular asset, you are saying that asset is going to buy. That's what you're saying. You are confident that the asset is going to buy. So that means that you are telling yourself that you are the one in control, right? Good. So if truly you are the one in control, or truly they are the one in control, moving price by 95% chances, that tells us that we do not have that control, no matter the strategy you learn. That's why you would learn strategy from someone that will tell you that I've been making money with this strategy, and then you learn it and you realize it's not working. So many of us have had that experience, right? I don't want to start calling out or telling people to indicate, right? We have learned different strategies. That's why the problem we have in the retail world is that we are always in an endless cycle of looking for the best strategy. But the truth of the matter is that strategy is not what will determine your success in this market. Strategy is only part of it. Strategy is just telling you when you get into the market, this is what you're supposed to do. Because all we do as retail traders, knowing that we don't have control, whatever strategy you are learning is putting you in a position to try to predict, to speculate to a great extent what the institutions are doing. Because we know we don't have control over what they do in the market. We don't know when they are going to buy. We don't know when they are going to sell. That is just the truth. But we expect or hope that when we buy a particular currency, that currency goes up does not mean you are the one, because you entered it, is now going up. No. You only happen to be lucky to be buying when they are buying. So the best thing you can do for yourself, when you know you don't have control over the market, the best thing that you can add to your strategy, like you learned yesterday, is what? Risk management. Risk management is what keeps you alive as a retail trader. Even institutions use risk management. One of the things that can keep you alive as a retail trader in this business is risk management. Your ability to manage risk, because you are entering into a that's why sometimes you see people, they tell you trading is very risky. Truth of the matter is that trading is very, very risky. Now, why is it too risky for you? Because you are not the one putting the money in the market to make the price go up or come down. So you are only going there to guess based on your strategy. So you learn a strategy, you go into the market, you see where they say you should buy, you see a psychological level, you enter it, and then you start praying and hoping that price will go up. You don't have control. But then there is something that you can do that can guarantee that no matter the amount of control that you don't have, you would constantly be in profit. Even if the strategy you have is a 30% win rate. Today, I'm going to show you, traders will like to talk about what's the win rate of your strategy. My own is 90%, my own is 80%, my own is 70%. And the same person who has 70% win rate, 80% win rate, 90% win rate is still blowing accounts. So what is the problem then? If you have 90% win rate, why then are you blowing accounts? If you're learning a strategy from somebody that told you that strategy is 90% win rate, how did that strategy now ended up blowing your account if it's 90% win rate? So if we are paying attention, we realize that something is not adding up. But then you'll be shocked that somebody that has a 30% win rate is making consistent profit in the market. And you'll be wondering, maybe if you're in a circle where a lot of people are talking and they'll be like, hey, my own is 30, 90, 60, 70, 80, 90, 100. And then somebody says 30% win rate. It will be easier for us to start laughing at that person. Because you'll be like, what is this one? What are you doing here? Now, that means your account is blown. No. I'm going to show you how with risk management is what keeps you alive in the forex market. Risk management is what deletes blowing of account from your diction. Risk management is what will help you stay alive in the forex market. And part of the risk management we're going to be discussing today is the risk to reward ratio. So today, because of this, and based on the background that I've laid, we are going to be going on that. We're going to be trying to understand risk management in trading. Because one of the things that risk management can give you in trading is capital preservation. The first rule of trading, the first rule of any form of investment, the first rule of any investment is capital protection, capital preservation. In anything, but whether you are trading, whether you are investing, capital preservation. How are you going to guarantee that no matter what happens, your capital is protected? If you are trading and you're learning a strategy and you're not having this at the back of your mind, and they call a trade in a signal group and you enter it and you are not asking yourself, how do I protect this capital? Then you are wrong. because one thing is inevitable. You'll be headed towards an inevitable end of blowing that account eventually. Today, every day we hear stories of people that moved $100 to $2,000. Those news don't freak me again. Because as long as if you moved it to $2,000 and you don't have risk management, once it's inevitable, that account will blow one day. It's not a prayer, but most of us can relate to what I'm talking about. So capital protection is very important. The second thing is mitigating risk. It helps you, risk management helps you to identify and assess and reduce potential trading risk by using stop loss. This prevents catastrophic losses. Let me call it what most of us know it to be, blowing of accounts. Risk management helps you to take profit levels based on risk to reward ratio. Now, risk management is crucial because it defines your trading longevity and is about surviving to thrive. As a retail trader, as long as you're not an institution, as a retail trader, your job is to do anything that can keep you alive in this market because money is hard to come by. So let's move in. Let's dive in. What exactly is risk to reward ratio? Now, let's try to make it as simple as possible. Risk to reward ratio is the comparison between the amount you stand to lose versus the amount you stand to gain in a trade. So what that tells you that before you enter a trade, the first thing you have to ask yourself, most of us are impulsive traders. Once you see gold, you just enter, use any lot size that is inside your MT4, you enter buy or enter sell. You don't even ask. You carry $50 and you enter into the market, you are taking gold with 0.05. You don't even know the amount of money that you're risking. What this means is that you must first of all identify how much do I want to risk in this business? How much do I want to risk in this trade? You have to think like an investor. If you are an investor, you have to think, how much am I investing in this trade, in this business? So the formula for risk to reward ratio or calculating risk to reward ratio is what? Potential reward over potential risk. So that means that one of the best things you can do for yourself, the best risk management or risk to reward ratios that you can use in trading is if you are trading and you want to risk your money to trade, you must risk $100 to potentially gain $300. This is one of the best investment advice. Now, let me ask you, if I came to you and I told you, I have a business and I want to show you, and you ask me how much, and I tell you that, okay, what we are going to be investing in this business is about 3 million, and we are investing 3 million, and then you ask me, how much are we going to make? And I tell you, we are looking at 500,000 naira. Does it even make sense? You are risking a whole 3 million in a business to make 500,000. That is not a good investment. That is not a good investment. One of the best investments is for you to risk 3 million to make 6 million. If you are risking 3 million to make 6 million, that is a good investment because it's worth the risk. So that's what you should be thinking. When you have a trade and you've learned a strategy and you're about to execute that strategy, before you open a trade, the first thing you should be asking yourself is what? Is this trade worth my money? And what will make it worth your money is if the trade has the potentials of you entering it with $10 and making $30. You entering it with $10 and making $20. You entering it with what? $100 and making $300, or $100 and making $200, or risking $50 to gain $100. So how you do the calculation is that you do potential risk. How much are you risking? $100. Divided by how much are you looking to make from this? Times 2 or times 3 or times 4. Whatever it is, you have to first of all know how much am I risking, and then you multiply it by 2, and then you put here. When you divide it, you'll be getting 1:2 or 1/3. So that is why it is very, very important before you enter a trade. You have to think of this. So you see why I said it's not just about strategy. You have to first of all ask yourself, how much am I risking in a trade? And if you check how much you're risking in a trade, it will help you to make sure you ask yourself. So that's why most of us, you find yourself in a signal group. We don't even know what is the risk to reward ratio of that setup, of that signal. We just jump into it. So it is very, very important that when you are entering a trade, the first thing you want to know is what is the risk to reward ratio. And one of the best ways to keep yourself afloat and give yourself a good risk management strategy in trading is to make sure that whatever strategy you are taking has the potentials of giving you at least from 1:2. That means that if you risk any amount, it can give you times 2 of that amount, or it can give you times 3 of that amount, or it can give you times 4 of that amount. Normally, I stay with 1:3, right? But most of us do 1:4. But make sure that it at least has to be times 2 of how much you are risking. If you're entering the market with $100 to gain $50, you are shifting yourself towards the direction of one day waking up and realizing that you've blown your account. And that is it. So now let's move on to the next one. The next thing we are going to learn is what we call a win rate. Now, what is a win rate? A win rate refers to the percentage of trades that results in a profit out of the total number of trades taken. Now, this is where I want to pay. This is where I want you to pay close attention. Any strategy that you are taking, you have to know the win rate of that strategy. You have to know. Because if you don't know the win rate of that strategy, you will not be able to calculate the expectancy of that strategy. That's why I tell most of my students, I tell them, listen, whenever you get a strategy or you're learning a strategy, make sure you on your own identify the win rate of that strategy. Don't take it hook, line, and sinker. If you don't know how to run a back test to confirm the data of that strategy, you can always meet your mentor, right? If you are part of our EQ Market Academy, we teach it every single week. We can have a session with you. And I think on the comment section, if you don't have account with us, just go to the comment section. You will see the link somewhere and you create your own account. That is the link. Create your own account and then use this link to create your own account. And you will get access to our mentorship program that we do every week. In those programs, in fact, next week is one of the things we are going to be teaching how to run a back test on a strategy. Because if you are going to use a strategy, a method of doing anything, you need to know what is the frequency of that thing working. If you do it 10 times, how many times will it be profitable? If you do it 100 times, how many times will it be profitable? As a retail trader, as long as you do not have control over what happens in the forex market, you can never get a 100% strategy win rate. That is just the truth. So you need to understand the win rate of your strategy. The first thing you need to do is before you enter a trade, first of all, know how much are you risking. And whatever you're risking, make sure that that trade has the potentials of giving you times 2 of it. The second thing is the win rate. So with the win rate, you will be able to know what is the win rate of that strategy. So how do you calculate a win rate? Total number of winning trades over total number of trades. So that means that if you have about 10 trades and you check and you realize every 10 trades that you take, you've noticed that out of that 10 trades, 6 of them are always winners. That means that 6 over 10, which is total number of winning trades, okay, over total number of trades, 6 over 10 multiplied by 100%, that will give you 60%. This is how you know the win rate of your strategy. So it tells you how often your strategy is successful. So it's not just about learning a strategy and rushing to go and trade it. You have to know what is the success rate of that strategy. And a high win rate can be misleading if your losers are bigger than your winners. So it still points us back to where? It still points us back to the risk to reward ratio. When you lose a trade, you lose 100 or you lose $100, a trade that you were shooting for 50 or you're shooting for 100, and when you lose it, you now lose 100 and you're shooting for 50, that is a bad trading decision. That is a very bad trading decision. Okay, so if you have a high win rate, and it can be misleading if your losers are bigger than your winners. That means if your risk to reward ratio, instead of being 1:3, it is now being 3:1. That means you're using $300 to pursue $100. That is a very messed up risk, and that is one of the easiest ways for us. That is why most of us are blowing accounts on the best strategies and we don't even know. So a low win rate can still be profitable if your winners are much larger than your losers. That means a low win rate, something as little as 30% win rate, can still put you in profit if your risk to reward ratio is from 1:2 or 1:3. A low win rate can give you a good profit if your risk to reward ratio is high. That is, the potential is higher than the risk that you are putting in the market. So that is it. I want you to pay. If you are getting value from this, I want you to type a 222 on the chat box. If you are getting value from this, I want you to type a 222 on the chat box. Let's see how many people are following up. And please, if you are the one marking on the screen, please help us. If you want to be the one constituting nuisance, please kindly leave the Zoom. All right? Stop marking on the screen. We have a lot of people who came here to change their lives, to learn how to make sure they don't ever blow accounts. So maybe if you are okay with blowing your account, kindly leave the Zoom and stop marking on the screen. Thank you. All right? So we have talked about 2 things now. We have talked about what? Risk to reward. And we know that risk to reward is what puts you at an advantage. Because if you're risking 1 to take 2, or you're risking 1 to take 3, or 1 to take 4, it gives you a whole lot of advantage. Okay? So now, we've talked about win rates. Most of us are familiar with win rates already. So now let's talk about the positive expectancy. Let's talk about the positive expectancy. What is positive expectancy? Now, positive expectancy is a tool that indicates long-term profitability. If you are in the forex market, you don't want to be profitable short-term. You don't want to join those that are making money today. They made $200, tomorrow they lost $800, right? So positive expectancy is something you should know. Don't worry, we are going to put all of them together. Positive expectancy is something you should know. You should learn it, you should know it, because it is one thing that gives you a mathematical advantage. So that means that as a retail trader, let me tell you now, your ability to become profitable in the forex market totally depends on the advantage or the edge that you have. It's not about strategy. Strategy is just one piece of the puzzle. That's why a lot of us have strategies and we're blowing accounts. It's not about strategy. You need to have a mathematical edge that would guarantee that no matter how many losing trades you have, you will still be in profit. If you take 10 trades, for every 10 trades, and you lose 7, and you make profit on 3, you have to, that is what gives you the ability to be in profit. So I want you to, if you've not been paying attention on the risk to reward ratio because you've heard about it, and you've not been paying attention to the, the win rate because you've heard about it, I want you at this point to pay attention to this, because this is what brings all of it together. It brings all of it together. Because positive expectancy is a tool that you must know and employ and make use of it if you must do what? If you must have a competitive edge in the market. Secondly, it gives you a combined matrix because it combines risk to reward with trades win rate. So that means that you're going to be working with the risk to reward and the win rate in order for you to even confirm if your trading system is profitable. So again, is a system with a positive expectancy should profit over many trades. So what that tells you is that your ability to become profitable in the market is not supposed to be pegged on one trade. For you to know if your system or your strategy is profitable, you must be making conclusion. You have to be concluding within 10 trades. After 10 trades, you ask yourself, was I in profit? Am I in profit? As a trader, it's not after 1 trade or 2 trades, right? You start making conclusions. Am I in profit after 3 trades? Okay, now now positive expectancy is another thing that can help you recoup your losses. Remember, I told you that if you learn whatever I'm going to teach you today, you will have no business with blowing your account. But one thing is inevitable: you cannot run away from losses in the forex market. But what we try to do is we try to minimize it using what? Risk to reward ratio, win rates, and most importantly, identifying the positive expectancy of what? Of the trade, positive expectancy of your system. Another thing it will do for you is it helps you recover from a drawdown. What we call a drawdown in the forex market, when you are trading and your capital is now less than what it was, it will always help you recover from a drawdown. You know, for example, if you have 5 consecutive losses, you can recoup that loss and recoup the profit with 1 or 2 winning trades at 1:3 risk to reward ratio. At 1:3 risk to reward ratio. So positive expectancy turns trading, it takes it away from a gambling game to a strategic game. Anything you are doing and you are not able to identify the positive expectancy or negative expectancy or the expectancy rate of whatever strategy you land or you are picking from someone, then you are playing the gambling game. That is why I don't even try to reconvince people when they tell me that trading is a gambling game. I don't even try to change their mind again, because the truth of the matter is that what most of us are doing in this industry is gambling. If you cannot sit down and confidently say that that your strategy has a positive expectancy, or that it has a negative expectancy, or that it has a consistency rate, then you are gambling. But by the time you learn positive expectancy, which is how to match your risk to reward ratio with your trade win rates, then that is when you can say that you are trading the market strategically. Let's move on. All right. So because of that, it's going to take us into what is trading expectancy. So expectancy or trading expectancy is what? Is the average amount you can win or lose per trade over time. Now, it did not say is the average amount you can win or you can expect to win or lose per trade, per trade, just like that, not over time. But when you're talking about overtime, we're talking about a couple of trades. Before you can identify if your system is profitable, you have to trade within a couple of trades and then identify if that system or that strategy that you learned have a good expectancy. Just like yesterday, Coach Priye taught us a strategy. With this class, you should be able to go back, not the strategy, but go back and go to your chart and start counting. Okay, I saw this setup here. I took it. If I'd taken it, it would have been profit. If I'd taken it, it would have been profit. If I'd taken it, it would have been loss. Do it over 100 trades. That's what I tell most of my students. Do it over 100 trades and divide that 100 by 10, 10, 10, 10, 10, and identify the first 10. How many was profitable? The second 10, how many was profitable? If you check the first 10 and 6 was profitable, second 10, 7 was profitable, third 10, 5 was profitable. By the time you calculate it, you would have gotten the average win rate of what you are learning. It's not just enough for you to learn a strategy. You need to know if that strategy works consistently and it has the capacity to keep making you profit in the market. So expectancy is a tool. It's like a shortcut without you going to look for the bigger softwares. This is a tool that you can use to ask yourself, based on my trading activity, based on what I've learned, and this strategy that I've decided to trade with, is it profitable? It is a tool that you use to confirm if this strategy, no matter the amount of losses you accumulate from this strategy, if at the end of every 10 trades, at the end of every 20 trades, you will still be seeing profits in your account. And that is what makes you a profitable trader. So an expectancy is the average amount you can expect to win or lose per trade over time. And it's calculated by W multiplied by A minus L times B. Now, don't be scared. If you don't like math class, I'm going to simplify this for you. All right? So now, let's take it one after the other. The W means winning rate. So that tells you that before you come to expectancy, you must have learned a strategy. You must have learned how much you want to be risking per trade, and you must have learned the win rate of that strategy. Are we following? Before you come to identify the expectancy of your strategy, you must have learned the win rate. You must have learned the what? The amount you want to be risking per trade, and you must have learned, most importantly, the what? The average win of that trade. So the first one is the W stands for winning rate percentage. So with this, you will know, okay, if my strategy is, just like we like to brag, my strategy is 50%, my strategy is 60%, my strategy is 70%. If you know the win rate of your strategy, and don't take it hook, line, and sinker based on who taught you the strategy, go and backtest it yourself. Because it's easy for us to come out and say we have a 50, 100. The average winning rate, the average win. So when you win, if you have, for instance, if you have a $1,000 account and you want to be risking 2% of your account per trade, 2% of $1,000 is $20. Or you're risking, maybe you have $10,000 and you want to be risking 2%. 2% is 200. So let's just say that your winning rate is 50 because W is for winning rate. A is for average win. So which means for every trade that you take, if you make profit on that trade, if you are risking $100 and you make profit on that trade, you would make, that is, if that trade is 1:2. If the trade has the potentials of giving you, that is when you risk 100, you would make 200. If you risk 100, you will make 200. That means the average win when you win and when that trade becomes profitable is 200. The losing rate, of course, if your win rate is 50, that means your losing rate is 50. If your win rate is 70, your losing rate is 30. If your win rate is 60, your losing rate is 40. We understand that numbers, right? So your losing rate is 40, which is what will be on the L, and the average loss when you lose is how much will you be losing? You'll be losing 100. So your win rate multiplied by your average win, your win rate is your win rate, which is 50%, multiplied by your average win, how much you will make if you did 1:2 or 1:3. But in this case, we're looking at 1:2. You risk 100 to make 200. So when you make 100. So the losing rate is 50, still the same 50, while the average loss or win is 100. So when you do the math, you do 0.5 multiplied by 200 minus 0.5 multiplied by 100. If you do the math, and this will give you 100, this will give you 50. If you minus this from this, you get plus. That is, you get 50. That means you are in profit. And that profit indicates one thing. You have a positive expectancy. If you run your strategy through this calculation, that means your strategy has a positive expectancy. So let me show you what I mean. Okay, let me show you what I mean. Now, let's use a 1:1 risk. That means you are the kind of person that if you are trading with maybe you are risking $10 in a trade, you are expecting to make $10 in that trade. If you are risking $10 in a trade, you are expecting to make $10 in that trade. And maybe your win rate is 50%. right? I'm not using those big numbers. I'm using, let's be realistic. If your win rate is 50% and you're the kind of person that you're kind of person that your trade is you risk $10 to make $10. So if you enter with $10, once you see $10 in the market, you call the trade. And you're using 50 as 50% win rate. That means winning rate multiplied by average win minus losing rate multiplied by average loss. So that means you risk 10 to make 10. At the end of the day, the expectancy would be break even. That means you did not make money and you did not lose money. Are we following? That means you did not make money and you did not lose money. Okay? So, but if your win rate is the same 50 and you are risking 1:2, that means you are risking this to make this. Okay? That means you are risking this to make this. 1:2. You're risking 10 to make 20. And you do the math. 50, which is the win rate, multiplied by the average win, minus the losing rate, multiplied by the average loss, which is 10 minus 5. That gives you a positive expectancy. That means over time, it indicates a profitable system over time. Okay? But for some of us that do this kind of thing, maybe here it might be 2:1. That means you're risking. This is your risk. You enter a trade and you have a large stop loss. And you just want it to move small, just small, so that I will cut it. If you are consistently trading like this, you will end at a negative expectancy. And what do I mean? Let's check it. So if you have the same 50% win rate, and you have 2:1 instead of 1:2, you have 1.5:1 risk to reward ratio. And your expectancy is what? 0. As your win rate is 50%, you are risking $10 to make what? 15. Or maybe you're risking 15. You're risking 10 to make more money. But then here, you ended up risking that 10, and then by the loss, the losing that you make, you're risking $15 actually, because you are risking, this is your risk, you're risking $15. So you risk $15, and then you expect once you make $10, you call the trade. So this is average win, and win rate multiplied by average win minus win rate, losing rate multiplied by your average loss. By the time you do the math, it will give you 5 minus 7.5, and then when you calculate it, you'll be getting about minus 2.5. That gives you a losing system. If your system is like this, and by the time you do the math, you will always end at a minus. That means that system over time will take you to the village conveniently without even transport fare. It will take you straight to the village. You wake up one day to realize that you have blown your account. All right? So let's go further. So because of that, this is just like a chart. Now, let's pay attention to this chart. If your strategy, the win rate of your strategy or the risk to reward ratio of your strategy is 1:1, pay attention. If the win rate of the risk to reward ratio of your strategy is 1:1, that is, you risk 10 to make 10, you risk 20 to make 20, you risk 30 to make 30, and your win rate is 20%, you cannot be a profitable trader. If your win rate, you're risking 1 to make 2, that means you're risking 10 to make $20. You're risking 50 to make $100, and your win rate is 30, you will not be profitable. Okay, let's finish with the 1:1. If you're risking 10 to make 10, 30 to make 30, 20% win rate, you won't be profitable. 30% win rate, you won't be profitable. 40% win rate, you won't be profitable. 50% win rate, you end at break even. That means if you trade over a month and your win rate is you're risking 10 to make 10, you will not be profitable. You won't be profitable, you won't lose. You can only become profitable by the time you are trading with a 60% win rate. With a 60% win rate. That's the only thing that can make you, that is risking 10 to make 10, profitable. Okay? Now, if you are using 1:2, that is, you're risking 10 to make 20. Okay? You're risking 10 to make 20. With 20% win rate, you will not be profitable. With 30% win rate, you will not be profitable. With 40% win rate, profitability only begins when you get to 40%, when you are trading with a strategy that is 40% win rate. Are you seeing why it is very important that when you learn a strategy, you have to build a system around it that shields your account and gives you capital protection? So you know already, because by that time you must have checked and seen that your strategy is 40% win rate. Then you ask yourself, am I risking 1 to make 2? If you are risking 1 to make 2 at 40% win rate, that is when profitability starts for you. If you are risking 1 to make 2 at 50%, you are profitable. If you are risking 1 to make 2 at 60%, you'll be profitable. Now, this is the sweet spot for me. If you are risking 1 to make times 3, that means you're risking 10 to make 30, or you're risking 100 to make 300. At 20, you will not be profitable. But ladies and gentlemen, at 30% win rate. So you remember what I told you about when you hear somebody say my win rate is 30%, you start laughing at the person. And we're going to practicalize it in a jiffy. Just give me a second. All right. At 30% win rate, you are already profitable. And if you're keeping to your system, you are profitable. At 40% win rate, you're very profitable. At 50% win rate, you're already doubling your account. At 1:3. 50% win rate, you are literally doubling your account. At 60% win rate, you are off the roof. Your profit curve is no more looking like this, it's looking like this. Now, if you are risking 1:4, that means you're risking 10 to make 40, or you're risking 100 to make what? 400. At 20% win rate, no profit, no loss. At 30% win rate, you are already profitable. 40 profitable, 50 profitable, 60 profitable. But then if your risk to reward ratio is 1:5, are you seeing the power of the risk to reward ratio and how fast it can put you profitably? It can make you profitable even when your win rate is 20%. 20% win rate. Even with a 20% win rate, at 1:5, you can be profitable. At 30% win rate, you're profitable. 40, you're profitable. 50, you're profitable. 60, you're very much profitable. And that is it. So let's do the maths a little bit. So for instance, I hope we can all see my screen. Please, at this point, if you can still see my screen, just type a 1. Just type a 1 on the chat box. And if you have gotten value up till now, I want you to type value, value, value. Type value, value, value. If you are getting value up till now, type value, value, value. For a lot of us that has been blowing their accounts, if you learn this, you will have no business with blowing your accounts. Because this is where discipline starts. I hate it when I hear people say psychology. Listen, this is an edge. And as a trader, if you have a trading edge, your trading edge can define your psychology. Because if I know that with 1:3 risk to reward ratio and 30% win rate, I can still be profitable. Then that means I can take 10 trades and the first 7 trades are lost. I can sleep well. Because I know that by the time I get to the 8th, 9th, 10th trade, I will already flip it back into profit. And I'm already in profit. If I know that my system, even at 30% win rate, I can still be profitable. Why? Because I'm using a risk to reward ratio of 1:3. And I have first 2 trades. This is you see revenge trading. Revenge trading. Trading and trying to push everything, trading with anger. These things control it. But imagine when you know that even if you trade 5 trades and you lose all of them, that you can still be in profit. Will it make you to go and revenge trade? Put it in the chat box. If you know that even after losing 6 trades, that by the time you have exhausted that 10 trades, will it make you to go and revenge trade? That you can still be in profit? No, is the answer. You will trade with peace of mind because you have built a risk edge that will hold you and consistently put you in profit no matter the amount of losses you have. And we are going to do it now. So first of all, let's just say you have a $10,000 account. This is the practical time. We are rounding up already. You have a $10,000 account. Okay, 10,000. I'm going to show you how with a 50% win rate, you can flip accounts. You can double your accounts taking 20 trades. Let's see. Let's do with 10,000. So imagine with $10,000, you're risking 1% of $10,000. 1% of $10,000 is what? Somebody give me an answer on the chat box. We're rounding up already. 1% of $10,000 is what? Somebody said use 100 naira, for example. 1% of $10,000 is what? 1%. I didn't say 10%. 1%. 1% of $10,000 is $100. So let's just say the first trade. You took the first trade. You are risking 1%. So the first trade, minus 10, minus 100, right? The second trade, we lost again, minus 100. The third trade, we lost again, minus 100. Please follow me. The fourth trade, we lost again, minus 100. We are using the worst case scenario. The fifth trade, minus 100. At this point, some people are already panicking. Remember that our risk to reward ratio is 1:3. So let me put it here so it will be obvious. Our risk to reward ratio is 1:3. That means we risk 100 for any trade that goes profit, that goes a loss, we will lose 1% of our accounts. But for every trade that goes in profit, we will make 300. So we've taken the first trade loss, second trade loss, third trade loss, fourth trade loss, fifth trade loss. At this point, a lot of people are already panicking. The sixth trade, we're already in loss. The seventh trade, we're already in loss. How many people will start panicking by now? A lot of people will be like, my strategy is not working. I backtested it, in fact, it's not working. You see why it's very important to stick to one strategy. Because when you stick to one strategy, One strategy, and you understand it like you know your name, it can give you all the money in the world. So listen, we have taken 7 consecutive trades. I'm using the worst case scenario. This doesn't happen all the time, but let's use the worst case scenario. You've taken 7 trades and you have lost 7 of them. And then the magic begins to happen. The 8th trade, you now made profit. It gave you what? Minus 300, right? The 9th trade, minus 300. The 10th trade, minus 300. I mean, plus 300, plus 300, plus 300, plus 300, right? Now, let's do the math. 100 into 7, that is the amount of times we lost it. 100 into 7 will give you what? Somebody give me an answer on the chat box. 100 into 7 will give you what? We give you what? 700. As at this time, we have already lost 700 of our money. And even when we have already lost 700 of our money, as at this point, after losing 700 of our money, how much do we have left here? We have 9,300 left. At this point, you're looking at your capital, you're asking yourself, am I sure I know what I'm doing? So at this point, you have already lost 700 minus 700. Then the magic begins to happen. 300 into 3 places. We give you how much? We give you how much? Plus what? I need answers. 900. Beautiful people. 900. Now let's do the maths. 900 minus 700. How much will it give us? How much will it give us? Now, we removed 700 from here. Now we are coming back to add the what? To add the 900 that we made in profits. How much are we going to be left with here? Somebody give me an answer. Somebody give me an answer. We have made extra profits. But some of you might be wondering, how did the extra profit enter? Add the 93 to the 900, 9,300 to the 900, you'll be at 10,200. How many percent increase in your capital do you have here? 2% profit. 2% profit. So if you are doing this on a monthly basis, you are cashing out $200 every month, while somebody who has not studied his positive expectancy is there struggling with 70% win rate, 100% win rate, 90% win rate, and still blowing accounts. But imagine how powerful you will be having this and still having a 70% win rate. You'll be literally flipping accounts like crazy. Let me show you another example of how you can flip any amount, double it times 2 in a month or in a particular amount of time and still be profitable with 50% win rate. And after that, we're going to round up. Okay? So now, let's just imagine that. Let me come down to the small money, because most of us start with the small money. And when I mean small money, anything you are doing with less than $100 in the market, you are setting yourself up. No matter the amount of positive expectancy that you have, you are setting yourself up for failure. If you want to know why, there is a link on our on the chat. Sign up, get an account, get it funded, and you will join our mentorship. You will learn it there. Anything you are doing with less than $100, you ask, because having a capital is part of an edge. Risk management is part of an edge. Win rate is part of an edge. A positive expectancy. These are systems that you build. But the first one that you build to start stacking the odds in your own favor is to have from $100 and above. Anything less than that, you are gambling. You are gambling. So let's go with the minimum. So the minimum is what? $100. Let's do 100. The minimum is $100, right? 100. So let's just say you are risking 5% per trade. Now, normally I don't advise 5%, but I only advise that you risk 5% of your trade. Did you see how we lost 7 trades here and we still have 93% of our account intact? Intact. You are rich. You are. Let's not go there. So we have $100 and you risk 5. Only use 4 to 5%. If your money is from $100 and $900, it is okay. In fact, from $100 to $500, from $500 and above, don't go close to 4 to 5%, because this is how we lose money. This is how we lose money. So if you are risking $100, okay, and now you have $100 and you're risking 5%, now you're supposed to take 20 trades. And from your system, you realize that after every 20 trades, you are realizing that the expectancy gives you 50% win rate. Win rate is 50%, and you're sticking to 1:3. You are sticking to 1:3. Again, so we now do the first trade. You take the first trade, 5% of $100 minus 5, lost. Another second trade, minus 5, lost. Third trade, minus 5, lost. Fourth trade, minus 5, lost. Fifth trade, minus 5, lost. Sixth trade, minus 5, lost. Seventh trade, minus 5, lost. Eighth trade, minus 5, lost. Ninth trade, minus 5, lost. 10th trade, minus 5, lost. You have taken a number of 10 trades. 10 good trades. And you've lost it. So at this point, how much do you have at this point? Somebody give me an answer. How much is your equity remaining at this point? How much is your equity remaining at this point? 50. Very good. So you have $50. is still nothing to freak out. Because if you know your system, at this point, if you know your system, you will not start revenge trading. So at this point, for every single trade we take now, we make $15. The profit starts rolling in. This can be scattered. It must not be like this. It can be random, right? But we are just trying to make an example of something. The 11th trade gives you what? $15. 12th, 15. 15.3, 15.4, 15.5, 15.6, 15.7, 15.8, 15.9, 15.10. So the next couple of trades now became profitable, leading you to. So that means for every trade you lose, you lost 5. For the ones you made profit, you made 15. Are you seeing? Now calculate 15 times 10. How much would it give you? 15 times 10. How much would it give you? 15 times 10. I want to see answers on the chat box. How much would it give you? 15 times 10. At this point, you have made a whopping profit of what? $150. I'm telling you, this is how you win in the forex market. Add this $150 to the $50 that you had left, right? Add it to the $50 that you had left. How much will you now have? You will have at that point double your money. You will have at that point double your money. Did you lose? Yes. Did you lose and lose big? Yes, we did. But did we make profit? Yes, we make. And at the end of the day, did we come out in profit? What was the positive expectancy of all these trades? Plus 150. Here, plus 200. Here, plus 150. And by the time you do this math, using what I've taught you today, you will be able to calculate. By the time I've done 10, by the time I've done 20, you do not give up on one trade. Your success is not tied to one trade. Your success is tied to an average amount of trade. That is when you can say if you are profitable or not, using risk to reward ratio, using win rates, combining the win rates with the risk to reward ratio to calculate and identify your positive or negative expectancy. And by the time you do that, you can get yourself to the point where you can gladly say that you have built not just a strategy, but you have built a risk strategy with positive expectancy. And what does this entail? It entails that you first of all, so now that you've learned all of this, what is the action? First of all, whatever strategy you have learned, go and find out the win rate of that strategy. Don't take it hook, line, and sinker. Even if I taught you a strategy, if I say the strategy is 70%, don't take my word for it. Go and find it out yourself by backtesting. If you want to learn how to backtest, make sure that you are on our mentorship program. If you are part of our traders that are trading with the equity platform, make sure that you have your account funded. Get your account manager and they will put you on that class. We'll be treating that class next week, how to backtest and get the data of what you are trading. If you are not yet on the equity platform or part of the EQ Market family, use the link in the chat box, create your account, fund it, verify it, and you will get access to this class. Nobody's asking you to pay for anything. So first of all, you need to go and learn how to backtest or demo trade and verify the win rate of that strategy. The next thing you must do, make sure you don't risk more than 1 to 2% of your account. But if you have from $100 and above, do not go anything past 5. Because by doing that, that means you're giving yourself a lot of opportunities in the market. The reason why people blow accounts is that we come into this market, we come into this business with the mentality that because we've learned a strategy, it's nothing, we can win it. And then you use that confidence. Like I tell it to my students, I call it a stupid confidence. A market that you do not control. Price that you do not know when it's going to buy or when it's going to sell. You don't know when the institutions are going to pump money. And you are so confident that you are risking 50% of your capital in one trade. 100% of your capital in one trade. Who told you that the trade will reverse at that point? Who told you that because you entered it, it will buy? These are questions I need you to be asking yourself. Who told you that by entering a buy, that it will buy? Who told you that by entering a sell, that it will sell? But if you're risking 1, 2, 3, even if you amass 10% loss, you still have 90% of your capital to yourself. And anything that makes you get to that 90%, you know that something is wrong with your strategy. So do not risk more than 1 to 2% of your capital. The next thing is define your risk to reward ratio. You will find that out when you are backtesting. Because you will know, okay, if I'm taking this ICT, maybe mitigation block, and every time I see mitigation block, whenever it goes in profit, it goes 1:2. Or whenever it goes in profit, it goes 1:3. You will get all those data when you are backtesting. And make sure that whatever trade you're going to take, worst case scenario, identify your average stop loss and take profit using risk to reward from 1:2 and above. Don't do 1:1. Because see, it takes a lot to be in this business. Mentally, it will stress you. So if I know this thing will stress me, why should I risk $10 to make $10? I'm shooting myself in the leg. I'd better go and do something else. So for it to be worth your time, this is what I tell myself. Before I take a trade, for it to be worth my time and worth the headache, by the time price is going up, coming down, price is going up, for it to be worth the headache that it will give me during the process of that trade playing out, I must be taking ×2 of whatever I'm risking. I must be taking times 3. If you're taking 1:1, you're shooting yourself in the leg. Then after that, calculate when you have gathered that and you have also gathered the win rate of that strategy and you're risking 1:2% and you're sticking to it. Now you go and calculate the expectancy ratio of your strategy. Go and find out if it's positive or negative. With the data you've gathered here and gathered here, it will help you to calculate it. And once you calculate it, you will know if you are in negative or in positive. You don't have to test negative or positive with your real money. That's why when you open an account with us, our account managers will always open a demo account for you and tell you, go and start testing. We're not telling you to come and blow your money. Go and test. Even if it's a signal service that you're collecting, go and test it so that you know what you are doing because you're responsible for your money, no other person. By the time you've done that, review 50 to 100 trades. Identify if the strategy has a positive or negative expectancy. Do it over 50 to 100 trades. This is a business. It's not gambling. You're not here to throw away money. Money is hard to come by. This is a business. Collect data. Data is king. Review 50 to 100 trades that you have backtested or that you have demo traded and determine your actual win rates and average risk to reward ratio. Use this data for refinement and you'll be in massive profit by the time you launch out. So, in conclusion, your path to consistent profitability is first of all, your risk to reward ratio. Risk to reward and expectancy are essential for long-term trading success. They are not negotiable. You can't negotiate it. Your risk to reward ratio is what gives you the odds, stacks the odds in your favor. Because let me be honest with you, life itself is not fair. Before you were born, the odds are already stacked against you. So when you are learning how to go about life, you are learning risk management, how to manage several situations. The same thing with the market. Before you come into this market, as long as 95% of money that goes into this market comes from institutional traders, the odds are already against you. The best thing you can do for yourself is start stacking the odds in your favor. And the first way to do it is the risk to reward ratio. Know the risk to reward ratio of your strategy. Calculate the expectancy. It will keep you on the long run. You are not, unless you are here to take money today and leave forex, then you have no business with this. But if you're here to build a business with it, then this is what you should go to. The second thing is that risk to reward ratio is your survival tool. It defines your edge and enables you to stack the odds in your favor. The fourth thing is that positive expectancy is the holy grail. If you've been attending a lot of training, so many people tell you strategy is not the holy grail. And it's the truth. But the holy grail, and the reason why I consider a lot of people consider it a holy grail, is because even with the worst strategy of 30% win rate, positive expectancy can still put you in profits. You can come in your trading history and see a lot of red, and somebody's asking you, how come you have a lot of red and you are still in profits? You'll laugh at the person because you know what he doesn't know. It is a data-driven approach that leads to measurable improvement and guarantees consistency in profitability. You want every month you're cashing out. Every week you're cashing out. You're paying yourself salary every month in, month out, week in, week out. And then the probabilistic venture, winning is not about being right all the time. As long as you're a retail trader, winning is not about, it's only institutional traders that when they're pumping money, they know it's going to buy. When they sell off a particular asset, they know it's going to sell. You don't have that information because you're a retail trader. I tell my students, you are. The earlier you accept that you're a retail trader, know your place in the market, success begins for you from there. So you're a retail trader. The best thing you can do for yourself is accept that losses will come. But the question you should be asking yourself, when the losses are coming, are they coming big? Are they coming small? When the profits are coming, are they coming big? Are they coming small? It is about being profitable over time. Embrace these strategies for a calmer and more profitable trading journey. And I tell you, your consistency with profitability will pay off eventually. If you got value at this point, I want you to blast the comment section with value. I want you to blast the comment section with value. I want us to blast the comment section with value. If you got value at this point, I want us to blast the comment section with value. Here at Equity EQ Market, we have an academy. In this academy, we take students by the hand. We teach them the integrities of this system. We follow them, we have them, we design their own consistent profitability system. We define their expectancy of their strategy. We help them get to consistent profitability. If you are not part of the family, at this point, there is a link in the chat box. Click on that link, create your Forex account, get it verified, get it funded, and account manager is going to reach out to you immediately. Create your account and let us start this journey together. And I assure you, if you can keep to everything you learned in this class today, profitability, you will know nothing. In fact, hearing that your account blew, it will be a thing of the past. But consistency will be something that you literally sleep in bed with all the time and all the time. you'll be profitable in the forex market. The recording of this class will get through to you. So I hope we all got value, and I hope we all learned from it. So like I normally tell my students, it's not enough to say you learned. It is not enough for you to type value. It is not enough for you to put up thumbs up. Go and practice it, implement it. If you are serious about see, throughout all this class, a lot of gurus are going to come and teach you their strategy. And don't joke with any of it. Take my word for it, they are all profitable. But whatever strategy you are going to learn, this is what is going to determine whether all the strategy you learned yesterday and the ones you are still going to learn tomorrow and more would even be profitable and make you profitable in the forex market. So get to work, practice, practice, practice. Practice makes improvement. Consistency is what puts you in the game. All right? You'll be added to the group by having an account. Get an account. Once you get an account, create an account with any of the links you see here, and then you will get your self-access to the group, okay? And all. Somebody said, please question, how do I set risk to reward ratio? You will learn that if you are part of us. Get to your account manager if you already get to your account managers if you're already in. But if you're not in, create your account tonight with these links, and you will get access to all of this and learn it and walk you through it, walk you together. We do it. I had a very wonderful time with you guys. It's been a wonderful experience, having these conversations with you guys. Tomorrow we are going to have another blast. Another one of the biggest traders in the forex market is coming to teach you a lot, another strategy, something that would make you consistently profitable. I think he's going to be teaching demand and supply or something. It's going to be big. Invite everyone you can to the call. Invite everyone you can to the call, and tomorrow is going to be big. Tomorrow is going to be excellent, and you're going to have a lot of value to take. Again, there is a link in the chat box if you want to join the community, the EQ Market community. Click on the link, create your account today, and we will get to you and get you access to our weekly mentorship program where you learn more of this and also get the recording for this. So until then, until I see you guys again, stay safe, have a wonderful evening, and have a profitable trading experience. Thank you very much.